Good afternoon, everyone. It's the 7th of April. My name is TUAN Vikramasinghe. I'm the head of research for Maybank Securities here in Singapore. It's a gloomy day outside, and it's gloomier in the markets as Trump's Liberation Day has really liberated the bears. How bad could things get? And what are the silver linings? Today's show is a Trump tariff special, and we have our experts. We have to discuss what we should be doing in markets like this. First, we have Anand, who's our regional equity research specialist and strategist, as well as head of research, joining us to discuss sector and country implications. We have our co-head of macro, Dr. Chua Hak Bin, discussing the economics implications. And I will look at the impact, especially for Singapore, as well as our Trump tariff winners portfolio. And also, in times like this, it is even more important to look for strong companies with strong fundamentals, and sustainable companies generally do pretty well during times like this. So we have our head of sustainability research, Jigar Shah, to discuss our latest sustainability portfolio for Singapore. And also we have a couple of ideas from our chart guy as well. But let's start with Anand, regional head of equity strategy. Anand, welcome to the show. Now, ASEAN markets, especially Vietnam, Thailand, Malaysia, have been hit by much higher tariffs than expected. In this context, how are you seeing the equity landscape for the region?
Yeah, hi, thanks, Dylan. Yeah, no surprises that ASEAN is selling off big time today. ASEAN has been a huge beneficiary of the, liberalizing world trade order of the last 80 years. So its abrupt halt and reversal last week by President Trump would obviously have huge repercussions and all negative, really, for ASEAN. I think when we look at the countries, in terms of potential safe havens, I think it's only on a relative basis that Singapore is a safe haven in current times. It has the lowest tariff imposed by the US, and it does have historical safe haven appeal as well. And I'm sure you'll cover the stocks in Singapore that would accentuate defensive-ness for investors looking to hide in Singapore dollar assets. For the other markets, for us, Vietnam is really difficult for us now. I mean, the tariffs at 46%, much, much higher than expected. And I think the Vietnamese are scrambling to respond. I think that market, we have picks, but we would only look to accumulate those after a potentially very sharp sell-off over the next couple of days. In terms of the other markets, we continue to like, on a relative basis, Malaysia and the Philippines. Malaysia, 24% tariffs, not so bad. But of course, we are still pending details on semiconductor sector-specific tariffs. That could be a negative. But generally, it comes off better than most ASEAN markets. And the Philippines, where we think, it's a very domestic demand-driven economy. And compared to Indonesia, which has, downside from potential commodity prices coming off dramatically, Philippines does not have that issue. In fact, they benefit from lower commodity prices in a big way. So the Philippines would be the other market that we would be relatively defensive and positive about.
Right. So how about Thailand and Indonesia? I mean, particularly, both of these markets have had quite a bit of, domestic issues as well, and that's actually been a drag on these markets. How will that impact going forward into especially with these tariffs right now?
Yeah, they're not really in a great position for what's happening now on the external front. I mean, Indonesia, you would think naturally being very domestic demand driven, it would serve as a prima facie safe haven. But because of the turmoil we've seen in the last month in Indonesia in terms of fiscal cutbacks to fund their new sovereign wealth fund, Dana Harta, there's a lot of skepticism that Indonesia's fiscal support for the economy, which is crucial. All ASEAN economies will be trying to support the economies both fiscally and monetarily by cutting rates. Indonesia's position to do that perhaps is not as strong as it used to be. Similarly for Thailand, the political issues that continue, we are seeing sub 3% GDP growth already. So they are entering this crisis from a weak position, particularly weak position economically. And their fiscal position is quite stretched. So the ability to fiscally stimulate is also quite limited. So those two countries would not be top of my list in terms of havens. I would prefer to gravitate towards Singapore, Malaysia, and the Philippines.
So on a relative basis, we overweight Singapore, Malaysia, Philippines, and more neutral to underweight on the rest of the ASEAN 6. Is that a reasonable?
That's right. Yeah.
Great. Okay, thanks, Anand, for joining us on that equity view.
Most welcome.
And let's go on to Hagbin. Hagbin, you've actually cut growth forecast for ASEAN by about 0.5%. What are some of the key risks that you're seeing?
So I guess on the back of those reciprocal tariffs, which were highly expected, we've trimmed our ASEAN growth forecast to 4.2% from 4.7 earlier. And and then the more trade reliant countries saw bigger downgrades, which was Vietnam, cut by 1, Malaysia 0.6, and we cut Singapore by 0.5 as well. So Singapore, even though it faced a pretty low relative baseline tariff of 10%, it's just very heavily dependent on trade. So but still, bear in mind that these downgrades are, haven't taken into account the possible, as highlighted by Anand, those 25% tariffs that may be imposed on semiconductors and pharmaceuticals. So we calculated that the effective tariff rate on Singapore is currently about 5%, but if that 25% comes into being, possibly by the end of this month, then the effective tariff rate on Singapore will rise to about 14%. Yeah, so that's triple the current tariff rate. And bear in mind that, of course, the assumptions do not build in the possible retaliation. China's retaliation came after our downgrade, and this week we could have the US retaliating. We could also have Europe as well as Canada retaliating. And of course, Trump himself has said that if any countries retaliate, we're gonna retaliate back, right? So that could bring the tariffs on China to 100% essentially. If that happens. So things are still fluid. I think risk is still, on the downside.
Right. So, I mean, I think that's the key thing to kind of put a pin on. The risks are still on the downside. So clearly, the cuts that you made are not the worst case scenario. So can you give us some indication of how much more bad could things get?
Of course, I think if this stays permanently and if all the tariffs starts escalating and this global trade war, spirals out of control. And I think bear in mind that so far the war is happening on the goods front, right? But we can't rule out if things get bad. Some of the Trump's measures could extend into the financial sector. It could, force countries to, there's talk about refinancing debt or imposing, frictional costs on buying U.S. treasuries or, other options, And of course, the American still dominates the financial system, right? The flow of funds and so on. So it starts, moving into that space. I think, of course, things could get far worse.
Got it. Got it. Now, as you just said, China has already retaliated with tariffs and export bans on their own. What do you make of this? And what else can China do domestically to, offset some of the negative effects of the US tariffs?
So I think China also over the weekend has come out to say that they will be coming in to provide more support, and I think they use the word even unconventional, unconventional support. So it could be, I presume, it could be funds directly to go in and stabilize perhaps the stock markets, or to give more funding for companies that could be impacted by this tariffs. It could provide more kind of tax credits and so on, on the tax side. And of course the kind of usual support that has been giving, support for the consumer spending and so on. So China still has a bit of fiscal space. I hope it delivers those but at best I think we can expect the China stimulus to stabilize. It's going to help cushion the impact, but I think of course overall the negative would still be negative.
Got it. Got it. Now, zooming in on Singapore, what fiscal and monetary measures can we expect as the most trade exposed countries in ASEAN?
So I think on the fiscal side, fortunately, Singapore is probably the only country that has the most fiscal space. I think, as you can see, most of the other ASEAN countries has been fiscally constrained because of the spending during the pandemic. So fiscal deficits are higher, public debt ratios are higher. Fortunately, on the Singapore side, they left quite a bit of operating surplus in this budget and also the accumulated surplus. So we estimated that Singapore has about, dry powder about 14 billion, roughly about 1.8% of GDP that they can deploy, before the end of the financial year. So I expect by the third quarter that they can come out with a stimulus package This time it will probably be more supported on the businesses side, exporters that could be hit. They could go back to the playbook and provide some kind of those kind of handouts that they give to firms that hire to retain workers, essentially a wage credit scheme as we've seen in the past. So I think those options could be very much on the table. And of course, on the monetary policy side, we're expecting the MAS to ease at the next meeting, probably next week. So shifting the slope to a slower rate appreciation. And we wouldn't rule out a complete shift to a neutral bias in the second half. Of course, the last shift to a neutral exchange rate bias was during COVID, right? But that could also help cushion the impact. So there's a bit more room on both fiscal and monetary side for Singapore, and I think so to help cushion the impact.
Great, thanks, Hagbin, for that. Now,
Thanks.
let's stay with Singapore. Now, the STI is down close to about 7% the last time I checked, which has happened only twice in 26 years, once in 2008 during GIC and once in 2020 during COVID. Now, as Hagbin said, there is no escaping the negative effects of Trump's tariffs, especially given that Singapore is very, very trade dependent. Having said that, on the tariffs itself, at 10%, Singapore is less bad than regional peers. That's something that Anand highlighted earlier as well. Now, this is a silver lining and could reinforce Singapore's relative safe haven status. And as Hagbin said earlier, Singapore does have the fiscal health and the dry powder to cushion a blow from the second, third degree sort of impacts. Now, from a negative sector impact, we think banks could be the most impacted, given that they're the economic front line. But the overall impact might not be as bad as what we initially thought. Margins are likely to get squeezed, given the fact that Fed might actually cut interest rates, and we might actually see a slowing down in terms of credit demand. But at the same time, if the tariffs get arbitraged and we do see supply chains moving towards this part of the world, the Sing banks should benefit the most, given that they have the most integrated cross-border banking capabilities. Plus, if China continues to stimulate their own domestic economy, that will have positive spillovers to Singapore as well, and the Singaporean banks as well. And plus, there is dividend visibility, given that all the capital returns that they have announced. The tech manufacturing sector could also see bumps driven by demand destruction, but the sector manufactures and exports mostly out of Singapore and Malaysia, so that might bring some cushioning. But the big wild card is how much more additional semiconductor tariffs will Trump impose. Now, in terms of sector and stock winners, we like stocks that are generating cash and have winning themes. We like industries like ST Engineering and Sembcorp Industries from global defense and energy themes, Raffles Medical and Comfort Delgro for domestic exposure. Some of the e-commerce names, although they have been hit quite badly, Sea and Grab, might actually see customers switching to their platforms because they offer a lower cost than physical stores. We also like yield plays like REITs, which is one of the most underheld sectors right now in Singapore, particularly domestic-oriented names like CICT and FCT, and also Singtel, given the very strong cash flows it has and the capital returns that it is promising. Also, some small and mid-cap names like CSC, who has a lot of exposure and businesses on the ground in the US, as well as ISO team, which can be play on the election as well. A lot of these stocks are down significantly today, so quite an interesting time to look at some of them. Now, before I bring Jigar in, there's an audience question here from John Tan, who says, after the last few days, all my kids and my kids' kids are no longer able to go to university. What are the signs to look for that bottom to ease in? Look, John, during markets like this, trying to forecast and predict the bottom is going to be hard. that's trying to catch a falling knife. So I think the reality is when you have markets like this, it is to have very strong conviction on good quality names. So some of the names that we kind of listed here in Singapore, we think they go beyond a bear market because they're driven by fundamentals. They've got strong order books, they've got strong businesses, they've got strong balance sheets and strong cash flow. So I think that's what you need to kind of look at this stage in the markets. If you don't own these stocks, look for entry opportunities, average down, and build a portfolio that can withstand this cycle. So do have a look at our overall Singapore strategy portfolio for that. Now, with that, let me bring Jigar in. And as I said, in times of great uncertainty, it is more important than ever to look at strong fundamentals. Generally, companies that have good sustainability practices also have good quality fundamentals as well. So Jigar is our head of sustainability research, and he has screened 54 Singapore companies on various ESG parameters. Jigar, what are the key conclusions from this report?
So, Thilan, on the Singapore country ESG focus report, which we published very recently, some of the key takeaways that we have are firstly, the emission intensity in value terms is decreasing, though in absolute terms emissions have gone up. But overall, in the long run, Singapore has managed to grow GDP more than its emissions over the last 20-25 years, which is very positive. Secondly, the usage of renewable energy is growing, and in fact, 3/4 of the companies under our coverage are showing some or the other uh, increase in the renewable energy usage. Thirdly, the disclosures have improved substantially, especially in the social and governance side. The environmental disclosures were anyway good. And we are also seeing substantial use of the sustainable finance. So these are some of the highlights of the uh, report that we have put out, and which has substantial other interesting disclosures on where are the leaders in every sector, and their detailed tear sheets. We are seeing substantial improvement in the overall ESG for the real estate, the REITs, telecom, and banks. I think these are the sectors which are seeing substantial improvement, and also technology.
Got it. And are there any sectors that have lagged as well, Jigar?
Yes, in terms of the laggards, one has to say that the scope 3 emission disclosures are not so great, and particularly I think consumer staples, healthcare, and oil and gas are the ones that are laggards.
Right. And just to get some clarity, how is Singapore corporates positioned on ESG compared to the rest of the region?
Definitely, Singapore is leading because of its pragmatic and proactive approach, where I think the country, though it accounts for only 0.1% of total emissions globally, they made the fuel switch many years ago from liquid fuel to gas and now to renewables. Their carbon price, which is explicit, is going from $5 to $25. So that is also driving up a lot of transition. It is the hub of sustainable finance. So that way, I think the companies are 3/4 of the companies under our coverage are using one or the other form of sustainable finance. So overall, and disclosures, I think almost all the companies that are under our coverage are using GRI-based disclosures. So that suggests that Singapore is more or less well ahead of most other countries. The second and third place I would say would be with Malaysia and Thailand. We also published a report similar to this on Malaysia in November last year. So I think Singapore is definitely on top in terms of disclosures and execution, and also the way they have shaped up the sustainable finance.
Got it. And just in the interest of time, I just want to highlight our ESG portfolio for Singapore. A lot of these stocks have been selected based on their clear targets and actions to reach net zero, business alignment to drive decarbonization, and also their own governance and execution. So you have names like, while in the short term, these stocks might be weakness. We are looking at a much more longer term portfolio. So names like DBS, UOB, OCBC are in this list. With that, thanks, Jigar, for joining us.
Thank you,
Then
Thilan. Good day.
then we turn to our chart guy. He's got two cells in place. One is for NAMCHEONG. The current downtrend is expected to continue for this stock, and for TUAN as well. The current downtrend is expected to continue. You can see a lot more details of that in our newsletter today. In terms of events and announcements, we've got quite a few macro events coming out. GDP out on the 14th of April. That's something that we'll be watching very, very closely, just ahead of all the tariff impacts. We also got the property index out on the 25th of April. Plus, we have the United Hampshire US REIT a call tomorrow on the 8th of April. I think that's quite important given the opportunities in the REIT sector. So do sign up for that if you haven't had a chance to do that. Now, before I go, one thing that I do want to say is that, look, you know, we are in a sea of red today, and it is going to be hard to stay calm and to hold on to conviction. But those are precisely the qualities that's going to see us through this market. Remember, bear markets end. .com ended, GFC ended, COVID ended. This one will too. So stay calm and stay tuned. Our research team is here to help you navigate these markets. We will have our views. And we will be communicating those views to you as they become available, and continue to read our research and continue to reach out to us. Thank you so much for joining us. Thank you for your support, and have a profitable trading week.